Hey everyone, welcome back to Corporate Decoder, the place where we turn boring corporate filings into something you can actually understand. Today we're diving into the AOG Institutional Fund's latest filing, and boy is it a roller coaster. Think of it as trying to predict the weather a year from now using only a squirrel's tail. Intrigued? Let's get started. This fund's basically saying, hey, we're not your grandma's mutual fund, we're doing things differently. They are trying to give investors access to investments typically reserved for the super rich, like private equity and real estate, while offering some but not much liquidity. This means you can't just pull your money out whenever you want. Before we continue, if you appreciate these insights from corporate filings, make sure you're subscribed. We also have a Discord community linked in the description below if you are interested in learning more. First things first, this document is a Form N2, which is what registered closed-end management investment companies like this one file with the SEC. It's a registration statement, but it's also an amendment because they are making changes to a previous filing. They are also saying that they might be continuously offering these securities, which means they plan to keep selling shares over time. The AOG Institutional Fund is set up as a Delaware statutory trust. Basically, it's a special type of business designed for managing investments, and it's registered under the Investment Company Act of 1940. That act is there to protect investors. Now, there are two types of shares being offered, Class A and Class I. Class A has a sales load, like a commission you pay up front. Class I doesn't have that upfront fee, but you need to be special to buy them. They are generally for bigger investors or people who have certain fee arrangements with their brokers. It says here that the fund hasn't applied for permission from the SEC to charge different expenses and fees between these share classes, with the exception of the sales load. Since you can't just sell your shares whenever you want, the fund offers to buy back some of your shares every quarter. This is called a repurchase offer. They'll buy back at least 5% and up to 25% of their outstanding shares, but this can vary. If everyone wants to sell, they might only buy back a portion of what you're offering. They might also offer additional repurchases at their discretion. There's also the potential to sell shares through something called the Nasdaq Fund Secondaries auction process, basically an online auction. But this depends on the board's approval and might not happen. If they do start this auction, keep in mind that you might get less than what the shares are actually worth at the time, and there's no guarantee anyone will even want to buy. The fund will pay fees to Nasdaq for this, so shareholders will indirectly bear such expenses. To get in on this fund, you'll need at least $25,000 to start. And if you want to add more later, it's a minimum of $5,000. Of course, they might lower these minimums if they feel like it. The fund's main goal is pretty simple: to seek to provide total return. The strategy is where things get interesting. They're trying to copy the endowment model used by big university endowments. This means investing in a lot of different things, especially stuff that isn't easy to buy and sell, like private equity, real estate, and venture capital. The Yale University endowment style of investing utilizes strategic partnerships and access to top investment managers. However, shareholders should not expect the fund's liquidity profile to match those of a university endowment style of investing utilizes strategic partnerships and access to top investment managers. However, shareholders should not expect the fund's liquidity profile to match those of a university endowment. They can put up to 75% of their money in foreign investments with no more than 50% in emerging markets. There are rules about using derivatives, which are like bets on investments, but in general, they can invest in pretty much anything. This includes publicly traded and private investment funds, real estate, energy, commodities, absolute return investments, and equities. The fund can borrow money to invest, but they can't borrow more than a third of their total assets. This is called leverage, and it can make gains bigger, but also losses. For managing all this, the advisor gets 1.49% of the fund's average daily managed assets per year. There are also other expenses that shareholders will pay, including expenses from the other investment funds they invest in. REITs, commodities, and so on all come with their own risks. But the biggest risk by far is liquidity, which is how easy it is to turn your investments into cash, because it's hard to sell shares in this fund. They do those repurchase offers, but only for a small percentage of the outstanding shares. So you might not be able to get your money out when you want, or for the price you want. This is not a short-term investment. There's also the auction, which might or might not happen. Let's look at the financials. I'm scrolling now to the financial highlights to make sense of these numbers. In 2024, the fund had about $68.7 million in assets, up from $62.9 million as the year before. That's good growth. They earned some money from operations, and after paying distributions, the value of each share went up. The total return for 2024 was 7.43%. That means investors earned 7.43% on their investment. Now, the expense ratio, how much it costs to run the fund, was 2.95% of average net assets. Keep in mind, this number does not include the fees from other investment funds the fund invests in. The net expense over assets is 4.26%. The cash they get from selling new shares is usually invested pretty quickly, within 6 months, but they might hold back some to pay for things like dividends, expenses, or those repurchase offers. This section describes investment policies. The main risks come from equity securities risk. The investments in those securities are subject to price fluctuations based on a number of issuer-specific and broader economic or international reasons. Real estate securities risks. The fund may invest in publicly traded and non-traded REITs or investment funds that hold real estate. Derivatives risk. The use of derivatives by the fund or the investment funds could subject the fund to regulation by the Commodity Futures Trading Commission, the CFTC, AOG. Credit risk. There is a risk that issuers of debt securities will not make payments, resulting in losses to the fund. Foreign investment risk. Foreign securities may be issued and traded in foreign currencies. Repurchase offers limited liquidity. There is no guarantee that shareholders will be able to sell all of their shares that they desire to sell in any particular repurchase offer. Cybersecurity risk. A cyber attack could potentially jeopardize the confidential, proprietary, and other information processed and stored in and transmitted through their computer systems and networks. L. Putnam Investment Management Co. is the investment advisor. The portfolio is co-managed by Aaron Rosen and Michael Bowench. It also discusses key items such as code of ethics, liability, and voting. And that's it. There's also some legal boilerplate, but it is not as important as the previous parts of the report. So what's the final verdict? This fund is betting on being able to pick investments that the average person can't get access to. It's aiming for high returns, but it's not without risk. It is important to highlight that they are making efforts to reduce operational expenses for their shareholders by contractually agreeing to limit fund expenses, which I think is quite important given how expenses will eat at your return. However, the high expenses are a concern, with over 4% in costs annually. If you believe in their investment strategy and can afford to lock up your money for a while, this could be an interesting option. But make sure you understand what you're getting into. Alright, that's our breakdown of AOG Institutional Fund's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for additional insights. Thanks for watching. See you next time.